Would you rather own 100% of a small pie or 10% of the bakery that makes thousands of them every single day? That's the kind of choice almost every entrepreneur faces at some point, because how you raise money for your business decides how much control you'll keep over it. Some founders trade a slice of ownership for growth capital. Others prefer to borrow money so they can stay in charge, but take on more risk. And a few ambitious ones build everything from the ground up on their own. There's no one-size-fits-all answer. And in this video, we're breaking down how companies actually get funded, the pros, cons, and long-term effects of debt, equity, and bootstrapping. Now, every business needs funding. That's a fact. And there are really only two main options: debt or equity. And whichever route you pick decides who holds the power, how much risk you carry, and how much wealth you keep if things go right. Most people don't realize that this choice on day one can determine whether you become rich or end up working as an employee in your own business. Let's put this into perspective. According to CB Insights, about 70% of early-stage startups raise money through equity, which means they sell part of their ownership in exchange for cash. And that makes sense, because in the beginning, most startups don't have profits, assets, or any credit history, so no bank's gonna hand them a loan. But once a business scales, the dynamic completely shifts. Over 90% of S&P 500 companies use debt as their primary funding method. These are some of the wealthiest corporations on Earth, and they still borrow. Take Apple, for instance. At the end of 2023, the company held around $162 billion in cash. Real liquid money. Yet it continued to issue billions in corporate bonds, deliberately putting itself into debt. Why? Because debt is cheaper than equity, it doesn't dilute ownership, and the interest payments are tax deductible. That means Apple can borrow billions, lower its taxes, and still maintain complete control over its empire. You see, equity buys you support, while debt buys you control. Both paths can make you incredibly successful or completely ruin you. So, let's break them down one by one and understand how they actually work. Let's start with equity funding. Equity is the go-to route for most startups. You exchange a portion of ownership for cash. If your company skyrockets, both you and your investors share the rewards. That's literally the entire idea behind shows like Shark Tank. But here's the trade-off. Every time you raise capital through equity, you're giving up a little more control. And by the time the big payday arrives, you might not even be running your own company anymore. In 2023 alone, venture capital firms around the world poured over $350 billion into startups. These kinds of deals helped create massive companies like Stripe, SpaceX, Figma, and OpenAI. Most of the voting power ended up in the hands of outside investors. Jobs still owned shares, but not enough to control the company. So in 1985, after a clash with Apple's board and the acting CEO, he was ousted from his own creation. That's the danger of equity. The more of your ownership you give away, the more authority you lose. Now let's break down how equity funding actually plays out. It starts with the early rounds, what's known as seed capital, usually coming from angel investors or early-stage VCs. It's called seed because you're planting the very first version of your idea. At this point, there's no revenue, no traction, maybe not even a finished product, just a pitch deck, a vision, and a lot of belief. The cash goes toward building a prototype, testing the market, and proving the concept works. It's basically like when your friend keeps asking for $10,000 to open another trendy coffee shop, except this time it's branded as a startup. Next comes Series A. Now the concept has proven itself, and it's time to show that it can actually grow. Series A is all about finding product market fit and turning an idea into a business. Investors here aren't just buying your dream anymore, they're buying your traction. You'll need real paying customers, visible growth charts, and a model that can scale. Now imagine that same friend, the coffee shop idea finally worked, but now he needs $1 million to franchise into another city. At this stage, investors start asking for board seats and monthly reports. Then comes Series B. This is where things get serious. It's about scaling what's already working. You've got customers, teams, and revenue. Now you're hiring fast, expanding into new markets, and building infrastructure. It's like turning one successful cafe into a nationwide chain. You need marketing, logistics, management, and strong operations to keep it running. At this stage, the investors are much bigger. major venture capital firms, and large growth equity players. They're no longer moved by your pitch, they're convinced only by your performance metrics. Next up comes Series C. Now you're entering the pre-IPO arena. This round is about dominating your market, buying competitors, expanding globally, and gearing up for the public stage. You're no longer raising a few million, it's tens or even hundreds of millions now. And those investors want a clear exit strategy. This isn't your local coffee shop story anymore. It's a massive beverage empire gunning for Starbucks-level dominance. At this point, you'll see private equity firms, hedge funds, and corporate giants jumping in early to secure a stake before the IPO window opens. And then comes the final act, going public. At some stage, every company needs a liquidity event, a massive payday for its early backers, and a new stream of capital to fuel expansion. That's where the IPO, or initial public offering, comes into play. Going public means listing your company on a major stock exchange, like the New York Stock Exchange or NASDAQ, where everyday investors and institutions can now buy shares. From that moment, your company is officially owned by the market. But it's not cheap. You'll need SEC approval, fully audited financials, and complete transparency with the public. Just preparing to list can cost millions in legal, accounting, and underwriting fees. And once you're public, every quarterly report is under the spotlight. Every misstep becomes headline news. Still, the public markets unlock the largest pools of money on the planet. An IPO lasts only a single day, but in those 24 hours, a company can raise hundreds of millions, sometimes billions. Alibaba raised $25 billion in a single day. Facebook brought in $16 billion. Even smaller IPOs can bring in $100 to $500 million instantly. Because here's the truth. There aren't many people sitting on $100 million in cash, but there are millions of investors with a few $1,000s each, all eager to buy into the next big thing. That's the true strength of the public markets. Thousands of small investments coming together to create one massive payday. But it comes with its own set of challenges, right? Now you're accountable to shareholders, analysts, and the media, and suddenly everyone's got an opinion. Miss an earnings target, your stock price plummets. Say the wrong thing at the wrong time, you could wipe out billions in market value overnight. In 2022, for example, Meta lost $230 billion in a single day after weak earnings results. And yes, even the founder can get fired if performance drops. That said, let's shift gears and talk about debt funding, because this path allows you to raise capital without giving up ownership. Unlike equity, where every dollar raised cuts off a slice of your company, debt is temporary. You borrow, you pay interest, and you move on, like while keeping full control. Used wisely, debt becomes a tool for leverage, helping you scale faster, without losing your seat at the table. This is exactly how some of the largest corporations on Earth expand, even when they're already sitting on billions in cash. That's why companies like Amazon, Microsoft, Meta, and Google all carry billions in debt on their balance sheets. Here's how it works. There are multiple ways to raise capital through debt, and the method depends on your company's size and stage. First, there's the classic business loan. The traditional approach, like you walk into a bank, request financing, get a lump sum up front, and agree to repay it monthly with interest. If your business already has steady revenue, assets, or reliable collateral, this method can work really well. You get the capital you need, and you keep 100% ownership. But here's the catch. The moment the money hits your account, the countdown begins. It doesn't matter if sales slow down or clients delay payments. The bank still expects its money on time, every time. And most startups don't even qualify for loans, because banks value stability, not potential. That's why borrowing to test a brand new idea is almost always a bad move. Second, we have lines of credit. Almost every modern business uses them, a flexible safety net for short-term funding. Every modern business uses a line of credit. Think of it as a backup plan. You get approved for a fixed amount and say $1 million. You can tap into it anytime, and you're only charged interest on what you actually borrow. The reason companies rely on this is simple. It helps them pay for today's expenses using tomorrow's income. Imagine your company secures a huge client who pays in 90 days. You'll still need to hire people, buy supplies, and deliver the work before the money comes in. That's where the line of credit fills the gap. It's how companies grow without breaking their cash flow. They borrow against revenue they expect later because income and expenses rarely align in the real world. That's how big retailers fill stores before the holiday rush, or how construction firms begin projects before receiving milestone payments. In most industries, the question isn't if you'll need a line of credit, it's how large a one you can get approved for. Then come corporate bonds. Once a company becomes large enough, it doesn't need bank loans anymore, it creates its own. That's what a corporate bond is in essence. For example, Apple might release a bond offering 3.5% interest over 10 years. Investors, hedge funds, pension funds, even governments buy those commitments. Apple gets immediate funding, while investors earn predictable returns. It's cheaper than spending their own reserves, and far cheaper than giving up equity. When Apple issues bonds, they're tapping into a global ocean of capital hungry to lend at low rates. They define the terms, and the market competes to invest. In a way, it's similar to an IPO. You're using public markets to raise cash fast. But in an IPO, you sell ownership. With bonds, you're only selling a promise to repay. Of course, this only works if investors trust you. Technically, any business can issue corporate bonds if it follows the rules. But be honest, would you rather lend your cash to Apple at 3.5% or to Jimmy's Auto Repair at 10%? Exactly. As you can imagine, there are several ways to use debt to grow or finance a business. But these three examples should give you a solid understanding of how it all works. Now there's one final strategy left, bootstrapping. In simple terms, it means you build everything on your own. No investors, no loans, no outside help. You start with whatever resources you've got and scale step by step. Most people overlook this, but bootstrapping is actually the default path. It's how nearly every side hustle begins. You start small, focus on profit instead of size, keep expenses low, and build only what truly matters. You improve things as you go. At first, you wear every hat: sales, marketing, product design, customer support. You're running the entire show yourself. Every bit of income either covers your needs or goes straight back into the business. And over time, if your idea is solid, it naturally starts to grow. No investors, no board meetings, no giving away ownership. If it succeeds, it's completely yours. If it fails, you close it, learn from it, and move on without any debt or obligations. Interestingly, that's exactly how ALUX was created, and it's the reason it still operates that way today. We could also discuss crowdfunding, but let's keep this episode focused and simple. Maybe we'll dive deeper into that topic if enough people want to see it. Until then, thank you for watching, my friend, and we'll see you again in the next one.